So this is a nice casual conversation over the course of it. And people here actually are on a spectrum. Some of you are using us for legal and financial, some of us just for legal, some of us, one of a married couple is using us for financial, but the other person isn't. So if that's an intermarriage squabble, I'll leave it up for something later.
Choice or what?
I don't know, I'm just telling you. I'm just telling you the way that it breaks out. What I mean to do by this is cover a couple of things. The first is, as you might imagine, in a room of individuals that are just associated to me by the fact that they became clients, there can be a wide spectrum of levels of sophistication, planning needs, all that kind of stuff. So what we're going to try to do is build on a foundation. We'll have just some of the lower level things that we've discussed, and that will be relevant. But for other people, it'll be like, okay, I know that, so be patient. We'll get to the stuff that's a little bit more sophisticated as we go through here. The other thing is I will answer every question that you have for me. You can interrupt me in the middle of it. I'm trying to make sure this is on. No, it'll sound a little better now. You can interrupt me in the middle of it if you'd like. I'd rather that you ask questions while we're in the middle of that section. But if you want to hold it for the end, we'll have a section at the end, and I'll stay here as long as people would like me to stay, and we've given you kind of the notepads so you can kind of jot notes along the way and also write down your question if you have it. Two things that we have handed out for you. The one on the bottom is just our most recent newsletter. We sent that out largely by email and by social media, but we also wanted to print some out, so in case you haven't seen that yet, that's for you, see what we're up to. And then the top sheet is just a summary of some of the new tax law changes and the numbers. And we're going to go over the relevancy of those and kind of like where they factor into the planning as we go through the presentation today, but that's kind of like a handout for you so you can see where things are going, what's important from there. This is for all of the compliance reasons, the important disclosure that I have to put up here. So anybody want me to read that entire thing? Okay. In a few months, I've got to update the copyright of that from 2024 to 2025. Before we get started, I want to thank everybody, because a lot of people in the room here did this, which has contributed to our Socktober charity drive. So we try to take on a charitable endeavor every quarter. We match it internally, but you all drive this. So we had Socktober, which is us collecting new socks. I'm glad with the people that are my clients, I don't have to stress new socks. Everybody gives me new socks. They don't give me any used socks. But these go off to the Homeless at Home Front. They collect and we donate them over, and then the firm matches it. And not letting you off the hook, we have our last quarter of charitable giving, which is we're going to be collecting Toys for Tots in the office. That is actually a November collection for a December pickup. I don't know if you've ever participated in that before, but while we will take anything that you want to give us for this to really become a holiday drive for the people that are going to do that, we have to actually get it in a little bit earlier. So beginning in November 1, we'll start to collect that and you'll start to see some of it. So we appreciate anything you can do. The agenda for today, the first thing we're going to do is just talk about the new numbers. I'm going to cover them in some summary and a little bit in some detail because some of these are cemented and we know that they're going to be new numbers. Some of them are projected. They're all relevant in terms of the discussion that we're going to have. I've broken this down into two major areas. So one of them is like planning that affects you. So tax planning that you could be taking on for yourself and issues that, subjects that are important for you to kind of think about. And then tax planning for your loved ones. So you might put this in the category of either inheritance, gifting, whether they're going to be children or something along those lines. These will be things that don't directly affect you, don't directly benefit you, but might benefit you kind of going down the next line and sort of topics for that. And then the last section is just our Q&A, okay? Hopefully this meets with your expectations. If not, you can ask for a refund for what you paid to be here, and I'm gladly will process that. So the first thing that came up recently was the announcement that there's going to be a 2.5% Social Security cost of living increase. This is down from where it's been in the last 3 years. So on the heels of COVID and all of the inflationary things that were happening in the sort of economic environment, we saw a year of about 8-point-something%. I think it was 8.3%. Next year after that, I think we saw something closer to 3% or so. And so this is going to be the lowest of the percentages that we've seen in a little while at 2.5. Just for those that are keeping score at home, this is just north of the average cost of living increase historically. So that number has just been around 2.1% over all of the years that they've done it. Some years it's been as little as 1%, some years it's been as high as obviously 8%, but that 2 and change is where it is. What they did in terms of the bracket thresholds, so we're going to talk about this in detail. You have the information in front of you in terms of the actual filing brackets that exist. But what they did is they increased those brackets about 2.8% across the board. So if we want to think about this in context, they gave a 2.5% Social Security cost of living increase, but they increased the size of the brackets overall slightly more than that. And that is, I don't want to say the word is unusual, but most of the time that I've seen this are in lockstep. If I see an 8% here, I say an 8% there. If I see 2% here, I say 2% there. So the fact that they're just a little bit disconnected is a little strange for me. And the common expected increase for your Medicare Part B premiums is also 2.8%. This is one of those numbers that is not cemented or concrete. So we know the tax brackets for next year. That's why I put them printed, and they're there for us to use in terms of our planning. We know the Social Security cost of living increase. That's been announced. That's certain. But what we don't know is what the Medicare Part B premiums are going to be or what those thresholds. As a reminder, those thresholds are disconnected from the income tax brackets. And so if we look on the sheet that I handed out, you're going to see brackets that are at that 10, 12, 22%. And you're going to see upper limits on that threshold, for example, to $48,000 or $96,000 at the 12% if you're married versus single. But then if you look at the bottom right-hand corner on the projected Medicare thresholds, you're going to see that those numbers have no connection to one another. The top of the threshold is $212,000 for married, and then between $212,000 and $256,000, they add, $71 or so to that. The tricky thing about planning for Medicare is that your Medicare Part B premiums are set by the modified adjusted gross income. Now let me pull that apart for everybody. That is pre-deductions. That's one of our highest numbers that's there. So it's, nobody here is working any longer. You might be working, all right, but it's past your 401k deductions, above the line deductions, but before your standard deductions or itemized deductions. So that modified adjusted gross income, I like to think of as the number at the bottom of the 1040 before I flip the page. Okay? That income from 2 years ago is what is applied to these numbers. So you'll know where your Medicare Part B premium is in 2025 based on your MAGI from 2023. Does that make sense to anybody? Did I lose anybody on that? Okay, so what makes this difficult from a planning perspective is that those Medicare premiums, as we're projecting an increase, do get increased every year. And so what we try to do in our planning is stay underneath the current year's number if we're doing planning to avoid a Medicare premium increase or to stay in one of the brackets, because we expect, although it's not guaranteed, that if we're in a bracket this year, we'll be well within that bracket 2 years from now, okay? But there's no guarantee on it. And one of the things that ends up being an unfortunate byproduct or just a part of the way this law is applied is this is a tripwire. So the moment you get $1 over what that threshold is, you are then, if you're married, paying the increase times 2, no matter which of those spouses is the one that caused the higher income. They don't care about that. And certainly if you're single, if you're over that threshold, paying that amount for the entire year. And you don't get an option. They just withhold it from your Social Security, and they just send you less money for the entire year. People ask me, is there an appeal process for that? Is there a way of appealing that number? And I say there is, but it's a very low chance of success. So you can make an appeal that there were certain events that occurred that drove your income higher, but let me tell you one of them that doesn't apply, which is I retired this year or 2 years ago. That one doesn't fly anywhere. I had a home sale and it's only going to happen once, and I had some extra capital gain. That doesn't matter. I needed to take more out of my 401k IRA, and that that doesn't fly either. So they have some things that are in there. One of the ones that does apply, though, is a change in filing status. So the idea that you were married before and you had higher income and you're single now, that is something that is available for appeal, but it's one of the only ones that we use for planning. Okay? Any questions on the Medicare increase? We've got the projected numbers, but don't rely on these until we send another missive out that says this is now the new number, but we just wanted to give these to you because they have often moved in concert with the income tax brackets. So when the income tax brackets go 2.8%, so do the Medicare Part B premiums, because that's everything in the taxable world. You wouldn't put Social Security in the taxable world. Social Security is in the income world. That's why it's just different from there. Speaking about income taxes, there's an increase to the standard deduction. So if you are under 65, and then there's an adjustment if you're over 65. But if you're under 65, we now have flat numbers there of $15,000 if you're single and $30,000 if you're married. Here's a reminder of the way that this works, and then we're going to dovetail this into some subjects for planning. Your standard deduction since 2016 has replaced what was a standard deduction and a personal exemption. If you remember back before the tax law changes, you could apply both. You would get your personal exemption no matter what, but since the standard deduction was smaller, you had a higher chance of being able to itemize. Now, since 2016, very few people are in a position to itemize because very few people have itemized deductions that reach either $15,000 as a single person or as high now as $30,000 couple. And if you're over 65, you would add an extra $1,600 per person or per spouse. So it'll either be $16,600 for a single person, or it'll be $33,200 for a married couple as your standard deduction. Okay? And those numbers are also solid. So these are the tax brackets that exist sort of here. This is the difference between single and 2024 and single 2025. So this increase from 11.6 to 11.925, that's basically the 2.8% increase that's across the board. And you'll see that this starts to gain momentum the higher tax bracket that you're in. By the time we get to 22%, there's an extra almost $3,000 of space inside of there. These tax brackets we're going to talk about in a little bit of what's coming down the road and changing in 2026 if nothing changes in the law. I'll give you a brief explanation because some people who have come to a workshop have heard that, but many of you who have not come to a workshop are hearing that sort of the first time. We may have covered it in an individual meeting. These are the shifts for the married people. Just as a make sure we're all on the same foundation, married people's brackets are up to the 24% bracket, twice the size of singles. So single people were at 11.6 and married people were at 23.2, and that's twice as much. And the same thing if we look at the 12% bracket, they were at 46 and change, and now they're at 94. Okay, and so these are going to double all the way until we get to the 32% bracket, and then they don't double. Right? Okay. This is an important topic for everybody, whether or not you are a financial services client of ours or not, meaning I just want you to know about it and I want you to factor it into your planning. So when the tax law changes of 2016 were passed, they were passed under something called reconciliation. And what that means from a civics lesson is that they didn't have to get 2/3 vote of the two houses of Congress to pass the law. They could just get by with 50.1% because it affected the budget. But there were two rules they had to abide by, and the OMB had to bless it and say that these two rules were met by anything that was proposed. The first is they could not increase the federal deficit by more than $1.5 trillion. So the federal government got a credit card free for $1.5 trillion. It was okay to run up the bill for $1.5 trillion. But here's the important part for this part of the planning. After 10 years, it could not increase the deficit at all. So this is why a law that was passed in 2016 is set to sunset in 2026. And the sunsetting provisions that are material for us are that they're going to go back to the higher tax rates that existed before the law was passed. So when the law was passed, we went down, and we went down from the 10, 15, 25% bracket down to 10, 12, 24, and 22, 24, 32. So there's ones on the left-hand side is where we currently are, and the ones on the right-hand side is where we are going. That's where the numbers are going. And one of the things that's important, so you can slot yourself into where you are in these brackets based on where you expect to be, but one of the things that I find to be really instructive for our planning is you'll notice this fourth tax bracket for both married and single is at 24%. You'll notice that where it's going for the 22% number is higher than that. Does everybody see that? So if you come across from 22, 22 is set to go to a number that's higher than 24. So that means that this bracket, where it'll be skating to in the future, will be bigger than the next bracket below it. What does this mean for tax planning? Well, we've got to place a bet someplace in what we're doing with our planning. We either have to bet that tax rates are going to be higher in the future, stay the same, or lower in the future. God bless you. And we're trying to make sure that we're making the best decision possible from that. Now, what I can represent to you is that this income tax rate environment is the lowest in history other than when there was no income tax. So it is unlikely that we'll see rates even lower than what we currently have. I don't believe necessarily that they are always going to go up. I'm not a doomsayer about that. But I do know that 2026, every politician that has to secure a vote, no matter which side of the aisle that they're on, will go to bed December 31st, 2025, and all they have to do is wake up January 1st, and these are going to be the new tax law changes. And they can blame it on everybody behind them because they didn't have to vote on anything. So is it more likely that we'll see these sunset provisions than when we were talking about our tax rate's going to increase because someone's going to vote on it? Yeah, it's more likely if they have to do nothing that they will go up. But the worst case scenario is that they'll keep them the same. Right? I think it's unlikely that we'll see them even lower. Why? We have an incredibly large deficit. It just has been created really since 2020, and a lot of the things that were done post-COVID, as well as a lot of the tax breaks, we've just seen this deficit increase. So there's a bill to be paid. We've got to figure out how to pay that bill. And no matter who, we're in New Jersey now, but some of you are in Pennsylvania, you have my sympathies for all of the election advertisement that's happening. No matter what happens from 2 weeks from now, all right, the people that will be in charge will decide where our tax rates are going. In other words, not only in the executive branch, but more in the legislative branch. And we've got to figure out, are we going to bet that they will go down even further than where they currently are given our budgetary constraints? And I think the answer is no. So what that means for our planning is that we are in a position where we are encouraging people to make larger Roth IRA conversions, sometimes even into the 24% bracket, which for a lot of people can feel like pretty big pill to swallow. You're like, you mean we're going to be this big of a tax bill? And I'm like, yeah, it's this big of a tax bill. Because one of two things is going to happen. If you happen to be married, when you slide from married to single, since your tax brackets are half as big, you might be in that fourth tax bracket anyway. That's the first thing that we're considering for our married people. The second thing is, if this tax law changes, then the rate that you'll be in at this third bracket is even bigger than if we went into the 24% bracket. So we have a 1% arbitrage or differential in our favor. And so from the perspective of doing planning, I'm like, let's get the federal government out of your life at the lowest tax rate that we're going to see, and let the rest of this money continue to grow. Now, we're going to get into planning for inheritances or the next generation, but I'm such a big advocate of making Roth IRA conversions really for three reasons. The first reason is once we're inside of that container, you don't ever have to take money out of there again. So we have now eliminated the concept of RMDs, and that can be very beneficial for people that are either worried about what happens if they're married, going from married to single, or worried about tax rates increasing in the future and that money getting forced out. So we now have this account that will grow at 0%, withdrawals come out at 0%, but I don't have to take anything out that I don't want. The second reason why this becomes helpful is if we need to take out money in the future, and this account is our inflation hedge, meaning your income's good now, you're living on what you need, but as things become more expensive 5, 10, 15 years down the road, you need to supplement your income. I'd rather supplement that income from an account that I just have to withdraw what you want and what you need, not extra because it's driving my taxes up. Does that make sense to everybody? Right? So it's now become more like a line of credit, a banking account that I just check out what I need. And then the third reason for that is that for those of you who care about the inheritance that you leave behind, and I say that with a smile on my face because some of you are like, look at anybody that's around me is lucky to get anything that they might have. But for those of you that do want to maximize what gets left for the next generation, that Roth IRA can grow for another 10 years tax-free as an inheritance. And that's different than a traditional IRA because a traditional IRA has to come out over those course of 10 years and it's taxable to the next person. So I'm giving something completely different when I leave a Roth IRA to the next generation because I'm leaving them an account that can continue to grow at 0% for the next 10 years. All right? So these 20, yeah, go ahead, Janet. No, please.
The tax increases you mentioned, but what about these itemized deductions like the old Schedule A?
That is a great question. And so one of the things that is set to happen in terms of the sunset provisions that are in there is we're still going to maintain a solitary standard deduction and we're not going back into a personal exemption and a standard deduction rule. So it's not that the entire law goes away. It's that the tax rates sunset and go back to what they were in 2016. So we don't have a different filing situation. We still have higher standard deductions or combined standard deductions and personal exemptions in 2026. That part isn't going away. We're not all of a sudden going to have a new opportunity for itemization. Okay. There's other law changes that went in there that are going to remain. For example, it used to be the case that you could deduct, I say this gently in the world, but investment management fees. We used to be able to take that off as a professional expense. That went away with this tax law change. It's not coming back.
And the same thing with the property tax.
Same thing with the limitation of $10,000 for SALT or state and local taxes. That limitation is also set to be the limitation. So it's not going to sunset with all of a sudden you have a much bigger amount that you can deduct off of it. You're still going to be limited to $10,000. And this makes sense even if we're being, mildly charitable to the legislators, which is if the goal was to stop the deficit from increasing after 10 years, I can't go back to an era where I could lower the amount of taxable income by throwing everything in there and getting greater itemization. In fact, what I need to do is limit the itemization so that I can have higher taxable income and then get more revenue. So it's consistent. It makes sense. Yeah. On politics 2 weeks before the election, but it is true that to the extent that we're both individual rate changes and corporate rate changes, and they benefited both individuals, the one that goes away in 10 years is the individual one, the ones that stay. I'm really, really sad, except I'm a business owner, and 2 years from now I get all the same qualified small business deductions that I got from before. So my tax planning doesn't change from a corporate business owner standpoint. It's to the individuals. Deanna?
I just wanted to make sure I understood correctly.
Please.
The 10%, the 10,000 deduction for
State and local taxes.
Yeah.
Mm-hmm.
Okay, so are you saying that we can use that in addition to the standard deduction?
No.
Okay.
What I'm saying is, what I'm saying is that this number that is your standard deduction if you're looking to itemize, the most that you can put in the itemized bucket from state and local taxes is $10,000. Then, if I want to get bigger than 14,600 or 29, or what's going to be 15 and 30, I now need to have medical expenses, charitable gifts, anything else that if I put that all together with the $10,000 max of state and local tax, I get over that number. And then all of a sudden, itemization becomes an option, a viable option, but not before then. Okay? Denise?
Will this chart be available?
Absolutely. Yeah, we'll make sure that we'll get that to you. Can you make sure we take a note for that and make sure we get that in terms of the higher tax brackets? Yeah. And if it's okay, we'll give you this immediately with 2024, knowing that we only have a few months left, and then eventually we'll have it updated when we start doing workshops in January with the new number. So let's talk a little bit about tax planning for you. By the way, any other questions on that? I'm sorry, I didn't mean to cut off the conversation. Are we good on the tax laws 2026? Okay. So new tax law changes, and these are things that you may have heard in the news, and they are updates, and I just want to make sure that we're all on the same page. When the Secure Act was passed in 2020, one of the law changes that was made is that you could not leave an inherited IRA, essentially to someone that's a non-spouse, and allow them to stretch that out over their lifetime. This will apply to anybody here in this room that dies now, because it's for a decedent that happens after January 1st, 2020. You may have, some of you, an inherited IRA that you got from somebody that died before 2020. And if that's the case, you can continue to stretch that out. That's grandfathered in. But for everyone that is going to be leaving behind or has received an inherited IRA from somebody that died after 2020, okay, for the 2-3 years after the law was passed, the IRS was wishy-washy about whether or not there were required distributions out of that account. They just in July promulgated regulations, rules, clarified that in fact there are mandatory distributions. So even if you wanted to defer it for 10 years, which I don't think is a great tax planning situation, you have to take out a minimum amount off of that, or what would be your own life expectancy payment, or an RMD for you as an owner. This is the case if somebody had reached their required beginning date, which is likely going to be the case for anybody in this room that gets an inherited IRA, because you're likely getting it from an aunt, a parent, somebody older than you, and so that they were past age 70 and a half for them, or 72, 73, depending on their age. If they died before this year, you still have to clear out that account by 10 years of their date of death. So the IRS playing footsie with whether or not you had to take a distribution does not change the fact that it has to be depleted by the end of the 10th year. All that they've clarified is that there is a required distribution from an inherited traditional IRA. Let's go back to my discussion on a Roth IRA. On a Roth IRA, if that's what you received after 2020, there are no mandatory distributions from that account. You can take elective distributions, but there's no required distribution. So this is only for an inherited traditional IRA. And the thing that goes hand in hand with that is they are assessing a 25% penalty for any missed distributions out of those accounts. And so one of the things that we're managing internally, especially for accounts that are held at Schwab or somewhere similar where we know this is an inherited IRA, is to audit now all of the distributions that needed to come out. So your own RMDs, making sure we're in line with that, but certainly for inherited IRAs as well, even if we might be doing some tax planning and trying to stretch it out to a later year where you've got lower taxes, something like that, we still have to make sure that that required minimum has come out. And if I dovetail this planning with the idea that tax rates are going up in 2 years, you might hear from our office the recommendation that we accelerate the distributions out of the inherited IRA this year and next year before we get to higher tax rates in the future. And so what we see internally is for those clients that we're managing accounts and have an inherited IRA, most of these are going away if we've got a 10 years because we're making, I would say more aggressive, but we're trying to clear them out knowing what the tax rates are and the fact that they're going to be lower. Want to be clear about these inherited IRAs. These are not not susceptible to Roth IRA conversions. The only thing that they can do is come out of the account. Okay? I can't change them into a Roth for you somewhere down the road. All I can do is take them out. All right? The last set of tax law changes that are part of the rules for inherited IRAs is that there's flexibility for spouses when they inherit their IRA to use the RMD schedule of the other spouse. Where is this beneficial? It's beneficial when the younger spouse dies first, because what it means is I can use their lower percentage because an older spouse is going to have a higher percentage, because generally speaking, the federal government is going to want this money to come out as fast as possible. Okay? So if you are the younger spouse, check your food, maybe have a food taster, all right? Because of the two of you, that's the one that needs to go. For those of you that are still working and getting earned income, they increased the catch-up amount for people aged between 60 and 63. So people should be aware that if you're over age 50, you had the opportunity to make catch-up contributions to your 401k, and those were around $5,000 depending on the kind of account and assuming that you otherwise were taking part of your employer's plan. They actually increased this to $10,000, so they are giving those people age 60 and up an opportunity to get faster. That's a typo. That should say age 60 to age 73. So basically the time in which you would take required minimum distributions. So it's to be 60 to 73. And if you are a high income earner, meaning that you have wage income in excess of $145,000, it is now mandatory for you to make your catch-up contributions into a Roth account. Now, I can't, for the life of me, and I will be honest, I didn't spend hours trying to figure this out. I can't figure out the logic to this. I can't figure out why the federal government is requiring you to put in an account that they don't get any taxes on, unless it means that they want the taxes this year, because all of your catch-up and anything that go into a Roth account, Roth 401k, is taxed this year. In other words, you don't get to take a deduction off of it. So I don't know if they're just trying to force the hand of higher income earners by getting them into higher tax brackets. They must have some number where 145 is some magic amount. It's in there. But I don't trust the federal government to be doing anything in my best interest, especially when it comes to the collection and administration of taxes. So I'm suspicious about why this is beneficial. I love that it's an after-tax account. So don't get me wrong. I'm bullish on Roth. I should get a T-shirt that says I love Roth IRAs. But I like the fact that it's in this tax-free account. I think it's the better move for a lot of people. I just can't figure out why it's required. Any questions on these law changes? So this is for this year, Denise.
Just to clarify, catch-up is if you were not putting in the maximum you could put in during that time period?
Not quite. Catch-up is that because, and I'll say this all gently while I'm not just looking directly at you in my response. Because you're older, we want to give you an accelerated schedule to put money in. It has no bearing on whether you put money in the past. It just means that if you're older, we're going to give you more room to put it in, because if you're younger than that age, you are limited to how much you can make in a contribution. About $25,000 is the number, but now this gets up to $35,000 for people over age 60 that want to set aside money, because they need to set aside more in order for it to be in this account for them to withdraw later. So this is not dependent on your behavior in the past. This is only dependent on your age, and the rules generally saying we're going to encourage you to make these contributions so that you have this account that you can live off of and don't become a thorn in the side of the federal government being a dependent entitlement case off of it. Now, the truth of the matter is that this is important for a lot of families, not a lot of families that we work with, but a lot of families, because the average savings account, even for people in their 50s, is paltry. We're talking about a couple $100,000. $150 might be a number that's average for people that's in there. Now, obviously, we have folks that are all over the spectrum. So it is helpful for people that haven't been prudent savers, but this rule applies whether or not you participated in any plan before, whether it's an employer plan up to the max, or you were just contributing extra to, like a traditional IRA, just giving your $7,000 into it. This is for the employer-sponsored account, and you can just choose to participate in it.
Employers. So you have to be making, you have to be earning, this has to be earned income.
Earned income. earned income, but you can also have earned income from self-employment. So if we were in a situation where we were doing some tax counseling to say, oh, are you doing anything you're kind of getting paid for? Why don't we create a solo 401k or a solo Roth 401k or a SEP Roth IRA or a SEP IRA, and then have the opportunity to contribute a higher amount to that. But you do need earned income, and it needs to be an employer-sponsored plan to get these higher numbers. Without an employer-sponsored plan, you're going to be limited to that $7,500 limit, which is what the limit is for this year for a traditional IRA or a Roth IRA off of those. I just want to make sure that their language is the same. I use them interchangeably because of the tax treatment. 401k, 403b, 457 IRA, but they are different. Those four numbers are all of the ones that are employer-sponsored, okay? And the individual retirement account, an IRA, is something that you open for yourself. You may have rolled old accounts into there, right? It could be something that you contribute to above and beyond your employer-sponsored plan. But these higher catch-up amounts, the $25,000, the $35,000, those are ones that your employer-sponsored, which is why the strategy of incorporating or running it through an incorporated business to have the higher room and space works that way. And it doesn't work if you don't run it through an employer-sponsored, at least to a higher number. Did you have a question? I thought, scratch, okay. Good. All right, so these are the tax law changes. Any other questions on this? Let's go to some strategies for this. Now I'm going to put these into categories, but out of necessity of the time allotment that we have here, for those of you that weren't in the room when I made the joke, this is either a 1 hour or 4 hour presentation. We're going to try to keep it on the 1.5 hour end of things. I can't go into a ton of detail of this, but I can answer any questions along the way. The first thing that we want to do is we want to manage our brackets. So what does managing our brackets look like? Well, inside of these tax rates, you'll see the top of the number that's in there, and I consider each of these tax rates to be its own individual bracket. So the top of the 10%, the top of the 12%, the top of the 22%. So bracket management is really about making sure that we stay within certain brackets when we're doing our withdrawals out of certain accounts, whether or not we are choosing to realize income in a particular year by selling something that has been long held, or if we want to make withdrawals and let's say have an annuity and that have a certain tax treatment. All of this is really being mindful of where we are in these brackets. And these brackets for me break into two different categories that I'm paying attention to. Doesn't always the same for everybody, but I look at the difference between the 12% and the 22% bracket. So I'm trying to manage the space there. So for people that can remain in the 12% bracket, it's great. And I want to stay there because the injury to go from 12 to 22 is 10 cents on the dollar. Everyone see the gap between that? The other bracket that I'm managing is the difference between the 24 and the 32% bracket. Again, because the injury there is 8%. So I'm not as concerned being in between the other brackets. 2% one way or the other, probably not a big deal. 10% one or the other, that's something to manage. 8% one or the other, that's something to manage. And I encourage you to do the same whether or not you're working with us. Okay? The other thing that goes part and parcel with this is Roth conversions generally. What does Roth conversions mean? Well, we can do one of two different strategies. I can use this bracket management to make my Roth conversions. What does that look like? Well, seeing where you are, and let's just use the same number so that we're on the same page from this. Just stay with me. Let's say that you are a single filer and you've got $80,000 of taxable income. That's after our standard deduction, everything else that's involved there. You'll see that you're in the 22% bracket. Everyone see where we are? We're between 48,000 and 103. Great. So you're at the 22% bracket. And you have roughly $23,000 of room in your bracket. So you can get another $23,000 and still only pay 22% off of it. And if you were 22% last year and you're 22% this year, it's likely you're going to be what? 22% next year. So this is the best tax bracket that we know. So my Roth conversions on first pass is to take this space and make the Roth conversion with just that space, because that is going to be the best tax bracket you'll ever see. Why allow the account to continue to grow, possibly push you into a higher bracket? The tax rates go up in 2026. Why let any of that come to fruition? Let's get out of business with the federal government with that $23,000. The next thing that we might do in terms of Roth conversions is to push them into the next bracket. Now, where does this come as being a benefit? Well, it comes in benefits two different ways. First, there's a break even, where paying higher taxes now will mean lower taxes in the future. It will be different for everybody, but what we do is try to quantify, hey, the break even for this looks like it may be 6, 7, or 8 years out, right? So we got to be clear. You're going to pay higher taxes now. It's not going to feel good. Like big pill to swallow, horse pill to swallow. But there's a point in time in the future where that comes back to bear on you. This is increasingly the case for people who are married, where the change is two things. First, the change in filing status, where the brackets are half as big, but also the inheritance of the IRA all in one spouse's name, and they still have to take required minimum distributions that they wouldn't even want from before, and now it pushes me into higher brackets. So it's the combination of two. I'm realizing more income at higher rates. So my Roth conversions at a more accelerated pace for married couples often has an earlier break-even point or a more sudden break-even point, which is the moment one spouse passes away. We see the break-even from that because we know we're going to be in a higher tax bracket. I told you there was two. That was one. The second one is as an inheritance. So if we start to project out what these accounts look like with 10 years of additional tax-free growth, then there's a break-even just from the moment that we make these conversions. I'm not hoping anybody here dies, but if you were to make the conversion this year and die this year, your beneficiaries would see the benefit of that because it would grow another 10 years tax-free, and we would get past whatever the break-even point would academically be if you were trying to keep it. So it's for both people when we do that. There is a third sort of layer to this Roth conversion planning, and this one comes into investment strategy. So I want to be clear, I'm not talking about investment products. I'm not making recommendations. This is especially the case for people that don't have us as financial advisors for this money. So I just want to be clear, educational purposes only, especially since we're recording this. Your investment strategy, if you think about it generally as being some stocks and some bonds, and some combination of that, your stocks and bonds have different anticipated or expected growth, meaning are things that are more volatile, which we would have in the portfolio anyway. Our growth stocks, our whatever that would be, are going to be some composition of an entire diverse portfolio. With me so far? And then we have stuff that is safer and other, okay, fine. This stuff that's going to grow more. When we apply an investment strategy to Roth conversions, we don't replicate the same portfolio in every account. So you wouldn't find, for example, in the traditional IRA, in the Roth IRA, in the taxable account, the same portfolio. In fact, what we would do is we'd put our thumb on the scale, and we would put the more aggressive, higher expected return inside of the Roth IRA account. Because if we're going to generally be invested with all of these different positions, we want the account that's taxed at 0 to be the one that grows the most. And the same thing's the case when we think about our fixed income or bond section. That stuff is throwing off interest all of the time. So if it's in bond funds, it's throwing off payments in the form of interest. We want to keep that in the traditional IRA. Why? Because I don't want to pay tax on that interest until I withdraw that money. And the nice thing about the tax-deferred account is it allows us to have the interest be paid out, but not pay any taxes on it until we take it out of the IRA, until we un-IRA it. And so I just wanted to kind of introduce that for everybody here, whether or not you're working with us, the idea that when you make the Roth conversions, if you're going to do that kind of on your own, also think about applying a modified or updated, more advanced investment strategy where you are putting more emphasis on the Roth IRA account with these higher expected returns and more growth-oriented investments. Okay? Any questions on that? Because I know that that's a lot of like verbal stuff with numbers and things and concepts. I want to pause there and make sure that everyone's with me with that idea. If you have us doing it, it happens automatically. That just is what we're doing. We're having more of those in there, but if you're not. The next thing that we want to do in terms of tax advantage income management, and this is also a layer of more advanced planning, is that some people are looking to create guaranteed income or at least increase their chances of success in retirement by having a higher guaranteed income from different sources. We are often using annuities to achieve that. These annuities can start inside of a traditional IRA, and if we have selected the correct product, we can make partial conversions of that annuity account so that it moves from the traditional IRA to the Roth IRA. Where is this beneficial? When we turn on the income, it's coming out of the tax-free account for life, rather than coming out of the taxable for life, or ordinary income tax for life. And I'll say to you in candor, not everybody is susceptible to getting all of the money in this category. Some of it has to do with your appetite for taxes. Sometimes it has to do with your age before we have to turn it on. And so I wouldn't put this out there saying everyone can have all their guaranteed income in a Roth IRA. That's not necessarily the case. But I would offer that we want to think about this. We want to consider as part of the planning, because the Roth IRA account can either be money for you while you're alive, or you can think about it as something that you're leaving behind as an inheritance, depending on where you put more emphasis as an overall goal. That will tell you, should you have all your guaranteed income in there, or maybe a portion of the guaranteed income and then a portion of the income somewhere else. I remember we just worked with a client just in the last week or so, speccing this out, and they had a lot of money outside of any form of an IRA, in a brokerage account, and they had a decent amount of money inside of a traditional IRA. We'll break that up. They had maybe $2.6 million one place and $1.3 million in the traditional IRA. And we said, listen, you have a lot of money outside of this taxable account here. And this looks like it's a pretty good account from which we are going to generate our income for you in retirement. But I want you to consider using an annuity that has an increasing value inside of the IRA, and we'll make conversions over the next 5 years. And in making those conversions, what we'll turn on later is money in a Roth that will grow over time as fixed as guaranteed income and is tax-free. So your inflation hedge is growing and it's at 0%. So it's that kind of thinking that we want to layer at that level of sophistication for people, so as they're moving through there, they're thinking about not only how am I going to get a check, but how much of that check do I get to keep? Because that's a factor of where we land these accounts. Okay? Any questions on this? Because I'm going to switch to IRMA and Modified Adjusted Gross Income Control. Okay. I can't believe that I'm 50 minutes into this and I'm on slide 14 out of 23. Okay, so the first one is managing our Modified Adjusted Gross Income. This is important for a couple of different reasons. And again, we don't typically follow an investment strategy that has a lot of municipal bonds, but some of you do. And I so wanted to make you aware that the interest that comes from tax-free municipal bonds is income tax-free to you, but has two sort of negative things for tax planning. The first is it increases the amount of your Social Security that's taxable. So it goes into that calculation to figure out how much of my Social Security is taxable. The second thing is it increases your modified adjusted gross income. So while you don't pay taxes on that number for federal income tax purposes, it is part of the calculation for Medicare Part B premiums. So be mindful of the investments that you're choosing and when you're realizing the gains out of this, because if you don't know where you sit in a Medicare tax bracket, you could be in a situation that 2 years down the road, you were really happy with all this tax-free interest, but now we're paying a higher amount of Medicare Part B premium, or to say it another way, we're having less Social Security deposited because we're all of a sudden in a higher tax bracket. Okay? The next thing that we can do to manage our taxable income is that some of you have large IRAs or IRAs in which you don't need income from it in order for you to live, okay? I know that some of you that require that say, I would like to be in that situation, so we're just going to apply this discussion across the board, whether or not it's your situation. But for those folks that have IRA money that they don't need to live on, but are taking mandatory distributions out of that, your required beginning date, you're old enough already, there's stuff that you want to take out of there, you can actually leave that as a direct payment to a charity, and that's called a qualified charitable distribution, and that is not included in your taxable income. Your limit, I think, is now maybe $110,000 or $120,000. It's an amount that you can do, and you can do that every year, but you can do it up to your required minimum distribution. You can do it as a portion of your required distribution. So if you go in and you're like, I have to take $20,000 out this year, you can do $10,000 to charity, and you can take $10,000 in your pocket. You won't pay tax on the 10 to charity. You will pay tax on the 10 in your pocket. Okay? There's one rule for this, or two related rules. The first is the check has to go directly to a charity. Okay? Can't go into your pocket and then you forward it. It has to go directly to a charity. Second, that check has to come out and be cashed before the end of the year. So this is something that has to be completed before December 31st, not something that you can do between January and April. Okay, so we want to back that up and make sure that that's done there. Yeah, Janet.
So the contribution, could it flow through a Schedule A if Schedule A exists, or?
Say more about that question. I'm a little confused. So what do you mean?
Well, okay, so you say you decide to make a $50,000 charitable
Yeah.
contribution with
Yes.
this program. Is that considered a tax deduction?
It's not a tax deduction. The way that it works, it sounds like you got to be making this up, but it's true.
Not income?
Yes, but the way that you do that is on the tax form, you list the amount that's in there, and they type in next to that number QCD, and then they just don't include it in the income. So there's no separate schedule or form that gets filed that says, of this amount, this is the amount that's the QCD. It's just they write the letters, like type the letters QCD next to the amount of the distribution, and they just don't count it. They don't count it when they total up everything that's in there. So that's why I was not confused by your question, but it's not something where there's a schedule that you point to and then you list, the same way that you would have like short-term and long-term capital gains, and you would like list out what you realize or dividend interest, and you would kind of have the schedule that then gets compiled on the front page. There's no schedule that compiles it. You just type the letters QCD. It threw me for a loop when I first learned about this. I was like, wait, they just type the letters? Yeah, they just type the letters, and then you tell them it was a QCD and you don't include it in the income. So that sounds made up to me, but that's the way that they do it.
So if you took it as income,
Mhm.
say you gave $50,000 to Homefront,
Yeah.
then where would that $50,000 appear?
I'm so sorry. So I want to say that we're saying the same thing because you gave some of that money to a charity. So if you took it as income, then you wouldn't want to then give it to the charity. If we wanted to deduct it, we would just give it straight to the charity from the account. If you, I'm just going to use your hypothetical, if I have $50,000 and I give 20 to Homefront, and I have $30,000 I took as income, then I'm going to list 50, and I'm going to put QCD $20,000, and I'm only going to include the $30,000 in my taxable income when I prepare the taxes. That's the way that they do it. So some people do it for all, some people do it for a portion. But what we need to make sure happens is that the amount that comes out, because kind of gets flowed through on a 1099, has the distribution to the charity with its tax ID number, and has a different amount of a distribution to you with your Social Security number. And so you'll sort of get two breakdowns off of that, because they'll have given, with a 1099, money out of that account to Charity A, and you'll get the 1099 that backs that up. Okay. I suppose that that's how the software picks up on the fact that it's included or it's not included. Okay. Other questions on QCDs from here? No? Everyone still awake? It's taxes. It's a root canal. You came in for a voluntary root canal for an hour and a half to 2 hours. What's wrong with you people? Adjusting to a tax-efficient withdrawal. So this is the category of where am I taking money from when I have multiple accounts on which to live. And so we're going to think about 3 different accounts. We're going to think about the taxable account, which is your brokerage account. That's the one that's after tax money. We're going to think about the tax deferred account. That's our IRA money. And then we're going to think about the tax-free account, which is our Roth. We want to make sure that we're distributing from here efficiently from that. What does efficiently look like? Well, if it's the brokerage account, sometimes efficiently is raising money, cash for distribution, by selling things that have a down position against things that have an up position so that we have a tax neutral situation where your taxes on that amount are zero off of it. And so we want to make sure that when we are realizing taxes in order to create income, we're doing it in a way where we get the best bang for our buck. What does that mean? Well, sometimes it means losers against winners, so it's zero. Sometimes it means realizing a small amount of gain for a large amount of cash. That's the tax amount distribution is more tax efficient. And then sometimes it means that as you're withdrawing money, we are pulling from these various buckets so that if we have to create an entire income for you, over a course of a year, if you're making one for yourself, you're not just pulling only from one account without regard to say, well, maybe I should slow down over here and take from this one instead, because we want to be able to manage that. Where does that look like in terms of the different accounts in gain? If you look at the 10 and 12% brackets that are in here, and I have another bullet point on this a little bit later, but I want to marry these two ideas. If you are within the 12% bracket, single or married, but anywhere in there, you are allowed to realize capital gains to the top of that 12% bracket at 0%. How many people have heard of tax loss harvesting before as a concept? Everyone in there? No? That's usually when you look at your accounts and sell the things that are down towards the end of the year to create a form of a loss. That's one concept, but I also want to introduce for you tax gains harvesting. And tax gains harvesting is that for those people that are in the 12% bracket, selling winners up to the top of that bracket so that you pay 0% on it, which will allow you to then sell them later for cash without realizing capital gains because you've hit the reset button. Does that make sense? I'm going to sell and rebuy into the same positions. I'll see 0%, but all I did was hit the reset button on my basis. And then when I need to sell them later to generate cash, it's a smaller amount of gains, if anything. Okay. Yeah, please, Marie.
It only counts for 10 to 12%.
Exactly. If you're over the 12%, then you will realize capital gains at a 15% bracket. Until you're around $200,000 of taxable income, then you get a 3.8% net investment income tax, what they usually call the Medicare or that kind of tax. And then if you're on top of a bigger number, you go to the 20% bracket. So most people are within 15% when they're realizing capital gains, but we want to make sure that we don't inadvertently cause an extra 8.8% off of it going from 15 to 23.8. And we'll want to make sure that we don't trigger that. Some strategic charitable giving strategies for yourselves in terms of taxable. One is to use donor-advised funds. What are donor-advised funds? Well, they are essentially nonprofit companies that you own without any of the administrative headache of creating a nonprofit company. It's easy enough just to go to Schwab or Fidelity or wherever you're holding money and say, I want to create a donor-advised fund. And what that allows you to do is make contributions that aren't directly given to the charity in that year. So some people want to be able to all right, I'm going to have a holding tank, almost like I'm keeping this money in here. But if I give $10,000 or $20,000 this year, I may not want that charity to get all the money at once. So I'm going to place it into a donor-advised fund. Where is this helpful with our planning? Well, remember the discussion around itemization and trying to get above the threshold number so that I can itemize. Well, one of the ways that I can itemize is that I can now aggregate multiple years of charitable giving and do it in 1 year, giving it to a donor-advised fund. So if I were going to give $10,000 a year anyway, maybe I want to give $30,000 a year this year. I'm not giving it to the charity immediately, right? I'm giving it to the donor-advised fund. I'll dole it out afterwards. But in this year, the $30,000 to the charity plus the $10,000 in property tax plus maybe some medical expenses, all of a sudden I can now itemize because I'm above the standard deduction. Everyone see how that works? Now, I'm going to do that for 1 year, and then I'm going to switch down to the standard deduction for the next 2 years because I won't have the same amount of charitable giving. but I can now aggregate this together and put that into one donor advised fund and do that for a particular year. It might be a good year where I have a lot of income and I want to have a deduction for that year. There's a couple of rules on this, just to be clear. The first is this money is ultimately going to a charity. This is not some thing where we can now bring it back to you. This is a completed gift into a charity. You can name successor custodians, so your children or beneficiaries can run the donor advised fund after you. These monies can be invested, so they're just not sitting there in cash, but they can be part of you can have a completely separate portfolio. Both Schwab and we internally have a different charitable portfolio for the way that those are set up. The other thing that you should know is that, because we learned this the hard way, to be honest with you, you can't make the donor advised fund the recipient of your qualified charitable distribution from the IRA. That qualified charitable distribution needs to go to a qualified charity. It can't go into your donor advised fund. So that's the only wrinkle with that. Yeah, Bob?
What is the advantage of putting the money into a advised fund
Yeah.
rather than just giving it directly to the charity? Because the charity would have the advantage of the use of those funds
Yes.
in year one
Yes.
rather than spread out over 3 years.
So I would say that there's two advantages to doing that. Both of them are related to the time period that you want to give the money to the charity. So not everybody wants that charity to receive all of the money at once. And so if I'm going to make a much larger gift than I would traditionally do, or if I want to be able to make a gift every year but take a tax deduction in 1 year, giving it to a donor advised fund as a holding tank and then doling it out years 2 and 3 from the donor advised fund will allow me to give steady giving rather than giving everything at once. So there are people that don't feel quite as charitable about the charity as you might about giving them all things at once. They want to dole it out slowly. Some people want to have it go out to multiple places, but they're not really sure if they want it to be that place for all of those years. So the donor advised fund can have different charities that it's doling it out to. You say one school 1 year, another school another year, and it's not even the same charity that's giving it, but they're also stretching that over a period of time. And some people want to make a gift later, but have the benefit of taking the tax deduction now. And so they may put that gift in there and make no distributions. They're just going to grow that account. And in growing that account, they would have gotten the charitable contribution for this year while also being able to take a deduction. Okay, so those, I think, would differ reasons why they might do it. If you're interested in doing charitable giving, giving appreciated assets rather than giving cash is a great strategy, because the charity will be able to realize the gains on those at 0%. And so if you start to think about whether or not you're going to give cash or appreciated assets, you can give things with a low basis in order to be able to gift that. Another strategy that we're using a little bit more with clients is to use charitable remainder trusts. And I said with life insurance, but what I'm really thinking about is this. And this is a structure for people that have concentrated positions with a lot of taxable gains in them. So these are going to be people that maybe worked in a company, have a lot of company stock, or might have long-held positions where they're like, I don't want to sell this money because of the big tax hit I'm going to have to do. I don't want to diversify this money because of the big tax hit. So instead what you're able to do is you're able to give it to a charitable remainder trust. So the charitable remainder trust is a bucket, and I'm going to give the assets in there, and I'm going to get 2 tax planning benefits. The first tax planning benefit is when I sell the assets from inside of the charitable remainder trust, the tax on that is 0. So I now have all of that money that's in there. I don't have to pay the federal government anything out of the taxes. So let's use $1 million just for the sake of discussion. If I had something that I bought for $200,000 and it's now worth $1 million, I now erase all of the $800,000 of gain. Now there's $1 million in the account, not that minus the taxes. That's the first benefit. For the value of the $1 million, I'm also able to take a charitable deduction. So there's a percentage the way this works out, and I can stretch that charitable deduction over multiple years. So now I can use that over 5 years, and now if I wasn't able to take a $300,000 tax deduction, I can take $60,000 a year, and all of a sudden, that's now on my taxes as an itemization. Good so far? Now if I layer that with my Roth conversions, how much space did I give myself to make free Roth conversions? $60,000 a year. Because the charitable itemization comes off of my taxable income, and now all of a sudden I'm able to make that. Now the reason why we couple these with life insurance is that this $1 million has got 2 places only it can go. Either return to you over a period of life, or sometimes shorter, or to the charity? Where is it not going to your kids ever? And so what we want to do is we want to marry that with a life insurance policy, because the moment you die after putting it in there, the balance of what's in the trust is going to charity. That could be year 1 or year 30. But whenever that is, that's the amount that's going into there. So what we want to do is we want to protect your beneficiaries by getting life insurance equal to the value of what you put in there. So if you happen to die early, you've replicated or created the wealth for them down the road. So it's typically how we marry these things, so that people aren't looking at me like, I could do this, but then I got to live 20 years. If not, then somehow a problem. And so they're kind of stuck in the phase of not doing the planning. I said, well, wait a second, what if we use another tool to be able to create wealth for the next generation? Now you don't worry about that. You get the benefit of having that money come back and also having a life insurance for your kids. Okay? That's sophisticated, but that's for people that are in a concentrated position where they're like, I could never imagine selling. I have a client, and that client, he's like to say that he bleeds brown. So he's a UPS worker that he's been there for like 3 or 4 years, and he has a multi-million-dollar portfolio that's in there. And the biggest, he said to his kids, listen, when I die, go hire Victor to manage it, but I can't sell this stuff now because there's so much in terms of embedded gains. So out of the $5 million, I think all $5 million is gain, because he just got a grant, a really super low number, and he worked there for 40 years. So using these charitable remainder trusts is a way for him to liberate that money, get a higher higher diversification with the investments, live off of it, but not leave anything less to the kids. Kind of a way that we would marry that. Let's go through these just real quick, because these are just traditional tax planning strategies. So this is just different ways that we can lower, either maximizing your standard deduction or lower the taxable income. So timing or grouping large medical expenses, again, so we can get over the standard deduction. So if you've got a lot of dental work that needs to go in place, or you have stuff that you're going to have to pay for out of pocket, doing that all in 1 year, or paying for it all in 1 year so we get above the threshold, is better than spacing it out, because it gives us the opportunity to make those types of gifts, and making sure that you're taking advantage of above the live deductions, which are our 401k or IRA contributions. Those would be traditional, not Roth, because those don't give you that. I'm going to switch over to legacy planning, so things that will happen for the next generation, your loved ones. Any questions on personal income tax planning or these topics that we've covered? I feel the need to accelerate the presentation, like I'm losing a good amount of the group in here, so we're going to keep going with this. I appreciate you being here. Okay, new tax law changes that I want to make people aware of, and some of these are like defined as of this year. They were introduced previously. Some of them have been around for a little while, and I just don't know where everybody is on this. The first one is the ability to convert dormant 529s into Roth IRAs. And so if a lot of problem has existed is in 529s that were there, they were unused or not used fully for children or grandchildren along the way. And they're like, what do I do with this? I'm running out of nieces and nephews to give this money in, because you may be familiar that you can replace the beneficiary of a 529. So some people were just like, how many family members can I give this to? You know, like my kids didn't use it, my grandkids aren't going to use it. Well, what we can do is we can convert that 529 into a Roth IRA. And there are limitations on this. Essentially, you can go up to $7,000 a year with a total of $35,000 total. You need to have had a 15-year holding period in the account, so it's not something you can create immediately and convert over. And the last contribution into that account must have happened at least 5 years prior. Okay, if you meet all of these requirements, you can do this. So all I want to do, put out in your head is, are there any dormant 529s? Consider converting them over into a Roth IRA. We can certainly open the account for you if you would like. The other tax law changes that are scheduled for this is a lowering of the federal estate tax exemption. So the federal estate tax exemption was both indexed for inflation as well as increased as part of the 2016 law changes. The consequence of that is that when we get to 2026, if nothing changes, we're going to get a reduction of the estate tax exemption amount from $14 million per person, approximately, to about $6.8 million per person, right? And so for people that are above the $6.8 million level, this becomes relevant. Or people who are projected to be on that 20 years from now, this becomes relevant because we either want to, in a married couple situation, double this and then make an assessment about whether we're up past this $14 million number, or we want to make sure that we are taking advantage of anything that we can do with gifting or lowering the estate tax exemption, the estate taxable amount by getting below this number. So we just kind of want to have it as a target along the way. Last thing in terms of tax law changes I already mentioned, which is that there are no required minimum distributions for inherited Roth IRAs. So if you leave that behind, the next generation does not have to take anything out of that account in the same way that they do from a traditional IRA. So the first thing that we want to be able to do in terms of estate tax reduction, by the way, this is relevant for those of you that are Pennsylvania residents, because Pennsylvania residents have an inheritance tax that will apply to children as well as people that are more extended family. New Jersey residents can leave things to children at 0%. And then if there are people outside of that family tree, then there's going to be a state inheritance tax that is applicable. But inheritance tax for PA residents is particularly something that we want to pay attention to, because most people who are just leaving it to children are going to pay taxes on that amount. And just for sake of putting everybody in the same foundation, it's 4.5% on the total account value. So that's the amount that is going to go or be owed as inheritance tax. It's 4.5% on all of the fair market value of everything that you own, whether it's in an IRA, outside of an IRA, Roth IRA, your home, another home. 4.5% is the number. So we want to think about reducing it for either situation, and one of the ones is that we can leverage this higher gifting amount. So the gift tax exclusion amount, which is on the handout sheet, is increasing to $19,000 per person per recipient. So again, in a married couple situation, it's going to be $38,000 per recipient. In a single situation, $19,000 that I can give to a child, and $19,000 I can give a spouse of that child, and $19,000 I can give to a grandchild. And so I can now leverage and compile these together. And that $19,000 limitation is not a taxable limitation, it's a reporting limitation. So if you're $19,000 or under, you file no forms with the IRS. If you're over $19,000 per person, you have to file a gift tax return, but you don't owe any money. Instead, what happens is you're letting the IRS know that you've given this amount of money, and they're reducing the amount that you can give at death before owing taxes. So now if we're in that situation where we are later in the world where it's $7 million per person, and I gave $100,000 to a child in 1 year, when I die, I can leave $6.9 million. If I give more than $6.9 million, I'm now going to owe gift tax. So that reporting requirement is just a way of them keeping a ledger on how much you've gifted and reducing the amount that you can gift at death. And so all we want to do is keep it within those limitations just so that we can do something clean and not worry about anything being affected when we pass away. Now we can leverage that with another strategy that I particularly love. Oh, go ahead first.
Annual gifting.
Mm-hmm.
Example.
Sure.
We buy things for our kids.
Yeah, that I don't worry about. I'm worried about you cutting. I'm cutting a check. Yeah, think about it, Denise, as a paper trail and evidence. It's if you were to be audited and they see money coming out of this and they're like, okay, what was this $25,000 check for? And it was like it was made out to a daughter. Well, that's a gift. You should have reported it, and now we go through this whole thing of like being over the exemption and whether or not that makes sense. So I'm really looking at this gifting. You can gift things that is not cash. So you can gift things of appreciated value. Some people will make a gift, for example, and this one is very insidious, where they will put a child's name on a deed. I just made a gift of half the value, because what did that child give me in return for me putting the name on the deed? The answer is zero. So I gave him a gift of at least half of the value of that. So we can gift things even when we're not aware that we're making the gift, that we're not just writing them a check. And it's really about that paper trail, that evidentiary, like think about how the IRS would discover it later. And that's the thing that we were going to be worried about. Putting $500 cash into an envelope, or writing a check for $1,000 here or $1,000 there as a gift is probably not going to reach that level of materiality. But I like this I'm sorry, did I answer that question? Okay, great. I like this with this strategy that I have not convinced enough people to do, which is combining the annual gifting to a beneficiary income to get them to make their Roth IRA contribution. So we think about this gift as something they can spend. Well, maybe they want to spend a portion of the gift, but they're also able to make a $500 or $7,000 contribution into a Roth IRA. Well, if I really want to make a gift to them, I can make that contribution for them. And it doesn't cost them anything different. They're already going to have been taxed on what they were taxed on for their income. That didn't change. right? The IRS and a custodian does not care where the source of funds are coming from. As long as you have an earned income sufficient to do this, you can make this contribution. So if you want to think about like the power of making annual gifts to a beneficiary in their Roth IRA and allow that to be compounded over time, this is an extremely powerful strategy of gifting from there. The only thing that I do is I beg of you, if I gave you this idea and you're not already giving me the money to manage, this is now a reward for this, because this is the most brilliant thing that you can do together and you've never heard of anybody from me. The other thing that we can do is make gifts to 529s with the intent of a Roth IRA contribution later. And what we're able to do with this 529 gift is make gifts above the Roth IRA contribution limitation. Does that make sense? Because the Roth limitation is going to be $7,000 a year, but I can make gifts all the way up to $19,000 into a 529 plan. And if I'm feeling particularly charitable, I can make 5 years worth of gifts at once. And so now all of a sudden I can seed this in here. I am limited in that 529 plan to a $35,000 Roth IRA conversion. Okay? So I would want to be able to do that for both educational expenses as well as a Roth IRA plan, but I can actually use both of these strategies together and say, okay, some of this is for a Roth IRA conversion 15 years down the road, and some of this is for educational expenses now, and I'm going to make both of those gifts in play. Okay? The last thing we can do in terms of reducing the amount for PA residents is that you are taxed on anything that you own when you die, with the exception of gifts that you made 1 year or more before you passed away. And so what we've often done is created irrevocable trusts that we have made completed gifts to, with the idea that we want to get them outside of the estate and avoid the 4.5% tax on it. Where is this beneficial for our PA residents? It's beneficial when I'm gifting assets that are not low basis, high appreciation assets. Why is that? Well, we have a basis adjustment at death. That means all of those gains disappear by virtue of somebody dying. So I don't want to give a home, for example, that has got $400,000 in gain, where I might have to pay 15% in capital gains tax later to avoid 4.5% on that same number. Does that make sense? So I want to really make that calculation on things that are not going to have a lot of embedded gains in there, because that's the kind of gifting that I want to do for anybody that's a PA resident, which is something that is already with a high basis or something that is going to have no basis adjustment later at death. And there's categories of investments that fall in there. In connection with that, one of the strategies that you can do is hold highly appreciated assets as your inheritance, the next things down the road. So if you're thinking about like, what am I going to leverage, what am I going to sell, what am I going to gift, you actually want to hold on to things that have a lot of appreciation in there, because you're going to be able to get a basis adjustment with death. And this is particularly important for married couples. I hate to think about this. You all know that I'm a happy, cheery person by nature, but I am professionally obligated to be, a black cloud floating around. When somebody has a health-related situation where somebody looks like they might be terminal, or they might look like they're going to pass away, or there's an age gap in a significant way, we might want to shift appreciated assets into the spouse that looks like they might be passing away, so that when they do, there's a full basis adjustment and not only half, because I'm sharing an account equally between the two. Does that make sense? I'm going to shift it over into the account of the person that looks like they're going to die, because that way I can now hit the reset button and be able to sell them later. So this is sell those assets later for 0% taxes. So this is both those situations. Talking about tax planning, some of you have children or grandchildren that are in a lower tax bracket than you, and will be for some period of time. I dread this concept because I want my kids to be self-sufficient and off the payroll as soon as possible, but it might be the case that they're going to be on the payroll even through graduation without gainful employment. I want to be clear for both the recording and my counsel that you should not be making this gift solely for the tax planning. They would call that a step transaction with respect to the IRS. But if you made a gift for reasons outside of tax planning and these highly appreciated assets were sold by this individual who was already in the 12% tax bracket, I can now sell these appreciated assets at 0% and avoid all of the state taxes in there. Okay? So it can't be solely for the purposes of tax planning, but this is a tax strategy that if I was making a gift for other reasons and they were able to sell them because they were in a lower tax bracket in there, I might see them for 0%. And that's another step-up basis or capital gains management strategy. 2 more slides, I promise, and we're done. Wealth creation. So one of the things that we are adept at doing is taking RMDs that are coming out that are not needed for income in your life and repurposing them to pay for a life insurance policy for the next generation. The reason why this is a powerful planning strategy, it allows us to magnify the value of those RMDs to a death benefit that's much higher and re-establish the value of that money because I had to pay taxes on it when it came out of the IRA. So this is not a Roth conversion, because I like Roth conversions, that's a zero tax account. These are for required minimum distributions that you're going to have to come out of these accounts forever. I can name anyone as the beneficiary of this life insurance. If I'm charitably inclined, I can leave it to a charity. If I want to leave it to children, I can leave it to children. But all I'm doing is I am leveraging those RMDs to a higher value than they could grow in the aggregate over your life, right? I can't grow it at the same rate that it would pay as a death benefit, and it's a tax-free benefit when I leave it. Let's layer that on top of something else. If you're a Pennsylvania resident, or if you're a New Jersey resident leaving money to otherwise an inheritance tax person, life insurance is exempt from that. So I've now increased that by the amount of the inheritance tax that I didn't pay. So I can marry both of those strategies together, okay? We've used this already for the beneficiary Roth IRAs. I want to remind you of that. And the last one, in terms of getting wealth into the next generation, you're allowed to pay the education or medical expenses directly to the institutions that are asking for this money and go above the annual gifting amount for that reason. So we have a few instances in which you can give more than $19,000. You can give up to 5 years of gifts, and you can do that by paying the institution directly. It's like a 529 direct into that account. I'm not giving it to them to give to the institution. I have to pay the institution, whether it's an educational or medical institution, directly in order to be able to go above that amount. Yeah, Janet?
So is it considered part of your lifetime?
Good question. Yeah, good question. The answer is no. I can give up to 5 years times $19,000 at once if I pay it directly into a 529 or the college, let's say. And that 5 times 9 situation, so is that $95,000? That 5 times 19 is all under the exclusion amount. I don't have to report it. I have no reporting requirement or anything like that. I can't give it again for the benefit of that child for 5 years. So next year I can't give another 5. I just put all 5 into 1 year because the bill was this year. Or I gave all 5 this year into a 529 plan because I wanted to put a lot of money to work. I didn't want to take 5 years of giving $19,000. I wanted to give $95,000 and let that be invested.
Does this only apply to college? Does it apply
Nope.
to?
No, you can go independent high school expenses. You can do it for Montessori, child expenses, and as long as I go directly to the institution, it's allowable.
And there's no reporting?
Correct, as long as I stay within either $19,000 or 19 times 5 at the max. I can't give more than 5 years into 1 year. So the bill for college, let's say, because I'm paying one now for my junior and another one starting next year. So let's say the bill for, this isn't his, thankfully my oldest son got a great scholarship, but let's say that's about $60,000. That's well above my $19,000 limitation. I could decide that I want to give 2 years worth of gifts at once, pay $40,000 towards that as a grandparent to a grandchild, and I will have given 2 years directly to the institution, non-reportable. Okay? The next year, I might want to give another 2 years. I'm still good because I've given less than 5 years, kind of all at once type of thing. And then the next year, I'm limited to 1 gift of 19. But then when I get to the third year, I can give 2 years again worth. So it's really that 5 years at once that I can't have given more than 5 years at any bracketed amount of time. off of there. So, okay. Alrighty, that is the end. Questions and answers, then I'll just leave you with one thing before we break. You all have been asking questions throughout, but is there any topic that I didn't get to that you wanted to ask specific questions about before we break for today? Keith?
Do you see any change coming on the capital gains taxes?
It depends who wins. And the answer is yes. The answer is yes based on proposals. So the most common proposal from the Democratic Party has been an increase in capital gains to about 40+% for people that make over $400,000. My concern, and so I'm largely apolitical in my professional life, right? I don't advertise what it is and just try to keep the facts to help my clients. My concern is that anytime the federal government gets their foot in the door, it's the beginning of something, not the limit of something. So this occurred most, like the example that's easiest is Social Security taxation. When Social Security was introduced, the promise was that it was never, ever going to be taxed. You paid taxes on this money already. Why would we ever? And everyone bought it because, like, yes, that makes sense. They were never going to ask that. Well, there are some people that are too rich or make too much money. And now we're going to have them pay some more tax on their money. I don't know a client that isn't paying Social Security as part of their taxable income because the thresholds on that schedule are so low in order to be able to get to, that taxation. All of a sudden, anything over $25,000, who's living on Social Security plus less than $25,000? Like very few. So my concern is that the introduction to that won't be something that affects a ton of clients right now, but will over time, 10, 15 years, once it's in there, like, this is good money, we're not giving this up. All of a sudden, let's lower it, 400,000 down to 300, 350 or something, or have something that's tiered in between that gets me from 15 to 44 with something in between, and obviously we're gonna have to manage that. So I wouldn't say, because I'm not a Chicken Little, realize as much of your capital gains as possible at 15% because of that reason, but I would be still managing the tax bracket to stay at that 15% because I'm still about the break point. 15 for me is okay, 23.8 is problematic. And really, for most people, that's the jump that they make. There's very few people that are at 20 alone. By the time you're at 20%, you're also at the 3.8%, so it's really 15 to 23.8. And that's really what I'm trying to manage to stay inside of there. Deanna, did you have a question?
You answered it.
Okay, good. Anybody else with any other questions in the Q&A? I just want to put one more slide before we leave. Yeah, go ahead. Great, good.
Okay, so what I'm trying to do is think about what you said in terms of, selling a losing asset
Mm-hmm.
and combining that with a winning asset.
Sure.
Okay, so I guess my question is, if you hold many things for a long time,
Yeah.
you're not likely to have
Yeah.
many losing positions.
No, that's true. I'll tell you the circumstance in which I have seen recently, even people who have been long in investments, still with some losing positions, which is 2022, we had a down year. And it was significantly down, about 20% or so. A lot of people who we were managing money for were rebalancing accounts in that period of time, which meant that we had lots of purchases, not a lot of purchases, but incidences of purchases. So we had lots that we might have bought in 2021 that were still down when we compare them. So I wouldn't say that positions that you've held for 10, 15 years might be negative. But to the extent you are reinvesting dividends and just plowing back in there, I would, for us at Schwab, I turn a little carrot on of it, and all of a sudden I see all the lots individual, and I might be able to pull lots out. And then I have to instruct Schwab to only sell that lot if I'm trying to do some tax management. So that's the only thing that I would say is that it's really about when you purchased something, because you might, as you break it apart, have individual positions that are worth more. Similarly, one of the things that I talked about today was getting more bang for our buck. And what that means is that you might be able to sell positions where the gain exists positive, but the amount of cash that it frees up is greater than it, right? So if you had something that you've held for 50 years, I might not want to sell that because it's almost all gain. But I have things that are gains that I've held for 5 years. I might be able to sell that, pay some capital gains taxes, but it's really on a small amount of growth, and all of a sudden I've liberated more cash for a lower amount of taxes. And that's sort of what I call the bang for the buck. Just look at what can I sell in order to generate the most amount of cash. I'm thinking about specifically a client that we're bringing on where they have about $1.6 million or so in positions that they had before they came with us. And they have about $160,000 of capital gains that they are going to realize. $160,000 capital gains taxes that they're going to have to pay. What I'm trying to do is get them to realize $80,000 or pay $80,000 in tax now out of the $1.6 million to give me access to almost $1 million to reinvest. Because the other $80,000 in taxes is for a much smaller percentage of accessible cash. Does that make sense? And so that's what we're looking at, is trying to be much more scalpel instead of sledgehammer with this. And so that we're kind of realizing that's what I would do in the same situation, is look at the individual lots and then be making sales off of those.
It's driven by lots,
Mm-hmm.
you know, so you can slice and dice.
Yeah.
Okay, so that would mean you'd have to keep track of.
Yes.
Or
Have the custodian keep track of. Since 2012, all custodians have to be managing a tax basis for things that they purchased. Every once in a while, we'll have a client come on and it's like, find the cost basis. It's like, where's Waldo? Because they've inherited it. It was pre-2012. The custodian didn't track it, and now we're trying to reconstitute it. And I even had a client where somebody was working on it in our office, like working with them, paperwork, whatever else, for 8 months. And we got as close as possible. And I consulted with every tax preparer, and they're like, pick a number. You know, it's not zero, and it's not the sale value today. So pick a number, and we're unlikely to be audited. But if we are, we might have to defend it. But let's get going with this, because we were never going to get it to certainty with whatever the amount we were trying to do. This happens a lot with stock grants or people that have just been purchasing. They loved Apple. They've always bought Apple. There's more cash. They bought more Apple, but just they didn't keep track of all of it. And so they had a number. Sometimes we get an average.
Oh, too bad I didn't buy a lot of bad stuff.
All right. Any other questions? Any other questions? I just want to put this up. I want to ask you to help somebody that you might care about. If this kind of information is relevant to somebody in your life, this QR code, it actually will lead you to a website. And within this website, somebody can register for a workshop. I think you all know me well enough to know that anybody that's invited is going to get the softest of sales presentations, if anything. The invitation is the end. It's just come in for a meeting and be able to meet with us and whatever else. It's not anything hard sell, but it is educational. It's 2 hours. And in addition to tax planning, which we kind of covered, there's also going to be income investments and estate tax or estate planning. And so we're going to cover all 4 worlds that we cover. For our planning, more importantly for the dates, is we're right here in this room in mid-November. That's a Tuesday, Wednesday, 19th and the 20th. One's at night and one's at 1 o'clock. If you have somebody that you know that you'd like to invite, you can come with them, by the way, if you want the education on income investments that you haven't heard from me. Everybody here is invited to come and attend. You are always welcome to come to our workshops. But if you want to bring somebody that would really help us out, and then they can be welcome to the client family. I give them a workbook. I don't know if we give them pastries. Everything we give them might be inside of a package. You got to open. Good. I am done for now, and I've made it to just about an hour and 35 minutes. So I'll stand up here. I'll turn the mic off so any conversations we have aren't broadcast. But if you have any questions, come and ask. It was really nice to see so many people here. And that's it. All right. Thank you so much for coming and taking time out of your day. Hope it was valuable.